Hi everybody. In this video we are going to discuss taxes payable for an individual. The objectives here are fairly straightforward. We're going to determine the gross federal taxes payable for an individual. We'll deal with things like tax credits in a different video. You'll recall that in order to determine an individual's taxes payable, we first need to calculate their taxable income. Now we did that in a previous video, and this is just a brief synopsis of what we determined. Net income for tax purposes, which is where we spent most of the course, less any of our loss carryovers, our capital losses, and our non-capital losses, any other specific deductions. This results in what we want. We seek taxable income. Now let's calculate some tax. Well, in order to determine an individual's gross federal taxes payable, we must multiply the taxable income previously determined by various progressive federal tax rates. So in a simplistic version, we start out with our taxable income, multiply it by those various progressive rates, and that's going to give us our gross federal taxes payable. Let's take a closer look.
Okay, everyone, so we're going to have to start our calculation of taxes payable. In order to do that, we need to look at the federal progressive tax rates, and we're going to take a look at our tax brackets. Now, the brackets are over here on this side. We've got our progressive rates over here, and we'll talk about what we've got on the far right in a second. Now, please note, both the brackets and potentially the rates could change on an annual basis. What we usually see is the brackets will go up as they're indexed to inflation on an annual basis, but the rates themselves generally stay the same unless you see a major change in government. A lot of the times when new governments, federal governments come into power, they'll campaign on the idea of changing the tax rates. Usually they're arguing for some sort of middle-class tax cut, and you'll see changes to the actual rates. There's nothing projected for the next little while. So for 2018, these rates should stay the same for the foreseeable future. Now, here's how the brackets work. For every dollar of taxable income up to, for the current year, $46,605, every dollar of taxable income a taxpayer earns is taxed at 15%. If a taxpayer earns exactly $46,605, what will happen is that they'll multiply out that 46,605 by the 15%, and this will be equivalent to what we have as a full bracket here. The amount of federal taxes payable will be $6,991. That's in the instance, the rare instance, a taxpayer earns exactly that much. So if a taxpayer were to earn something along the lines of $30,000, again, they would multiply the 30,000 times that first progressive rate, and then the result of that multiplication would be the amount of federal taxes payable. Now, as everybody should know by this point, in Canada, we have what is called a progressive tax system, which means that as taxpayers earn higher amounts of taxable income, they are taxed at higher rates. What this means is that if you were a taxpayer earning somewhere around, let's say, $50,000, you would fall into this bracket here, our second tax bracket, and what you would have is the first $46,605 would be taxed at 15%, and anything after that between $50,000 and $46,607 would be taxed at 20.5, and you would add them together. So the far right column here indicates the cumulative amount of tax that would be paid if, in fact, a taxpayer was making an amount that would fill up the entire tax bracket. So you saw for the first bracket, 46,605, the cumulative tax would be $6,991. If a taxpayer was making exactly $93,208, which is the high end of this bracket, they would be paying $16,544 in tax. So these aren't additional. We don't add $69.91 to $16,554. $16,554 is the amount of federal taxes that would be paid if, in fact, you had earned $93,208. You fill up the first bracket, and then you fill up the second bracket. Now, if you earn, let's say, $100,000, you'd be falling into this bracket. So what you would have is, in terms of federal taxes payable, $16,544 over here, plus 26% of any difference between 93,209 and 100,000, for example. The highest tax bracket, this is actually semi-new, federal tax bracket, is 33%. And this means that a taxpayer, any dollar of taxable income over 205,844 is going to be taxed federally at 33%. Now, these brackets don't take into account provincial taxes payable, which really isn't a subject for this course, nor do they take into account federal non-refundable tax credits, which we're going to talk about pretty shortly. But hopefully, a good understanding and comprehension of this table right here will allow you to calculate federal taxes payable for any taxpayer. We're going to do a few examples of that coming up shortly.
Last slide, I discussed the tax brackets and rates for 2018, and here I thought I would show you the updated tax brackets for 2019. You can see how they compare, and you can also see that the actual rates themselves haven't changed at all from the prior year, and that's fairly common. We may see some rate changes coming up as we've had a new government recently elected, depending on when you're watching this, of course. So anyway, these brackets function in the exact same way as the 2018 numbers would, except of course you can see that they've been slightly updated to account for inflation from year to year. And my expectation on exams, if you're taking them in the fall of 2019 or the winter spring of 2020, would be you would be using the 2019 tax brackets. Just a quick heads up that for the next couple of examples, I will be using the 2018 federal tax brackets as opposed to the 2019 ones. Again, you'll be provided with all the 2019 information on your exam, so it shouldn't be any sort of challenge for you to reproduce this and apply the same theory here, only using slightly different tax brackets.
All right, so let's take a look at an example of a taxpayer who has $100,000 of taxable income, and then we will calculate their federal taxes payable. So we're going to start out in that first bracket, right? This taxpayer has $100,000 worth of taxable income. So the first 46,605 are taxed at 15%. Multiply that out, that fills up our bracket at 6,991. Now, the next bracket between 93,208 and 46,605 is taxed at 20.5%. We don't double tax, meaning we don't tax again those dollars that were taxed in the first bracket, so we subtract all the dollars of taxable income that were taxed in that first bracket. So 93,208 minus 46,605 gives us $9,554 of federal tax. We then have the remainder, the difference between $100,000 and the high end of that second bracket, 93,208, so about $7,000. We multiply that by 26%, which is our middle bracket there. It gives us $1,766. We add all those dollars up, and we have total federal tax payable of $18,311. So this is interesting. A lot of times a taxpayer will want to know, well, what's my actual effective rate of tax that I'm paying? Because we have a progressive system, it's hard to know exactly how much tax is being taxed on every dollar earned. So what you do to come up with what we call the effective tax rate is you take the total amount of federal tax and you divide it by the total amount of taxable income. Now in this case, it gives us 18.3%. which is basically an amalgamation of all of those rates that we've seen already. Now, if we want to tell the taxpayer what their marginal rate is, this is a different terminology. The marginal rate means, well, what if I earn one more dollar of taxable income, what rate will that be taxed at? And this person is in a marginal rate of 26% until they reach the high end of that bracket, which is 144,490. So until that next tax bracket is reached, the marginal rate is 26%. We might as well walk through a few more examples of the calculation of federal taxes payable so that you really have a good understanding of this when it comes up on an exam. Now, please do note that on an exam, I will provide you with the tax brackets and the progressive rates, as well as the cumulative amount of tax that has been generated throughout those brackets. So you don't have to memorize this stuff. I feel like that would be cruel. So let's take a look at 4 examples here. We've got Amar. Marco, Kenzie, and Deepika with taxable incomes of $160,000, $95,000, $64,000, and $390,000 respectively. So our first example here, we'll take a look at Amar. So Amar, we know that Amar is making $160,000. So his marginal rate is here in this fourth bracket of 29%. To take a little shortcut, we know that we can start with 29,877 because that's those first three brackets, they're entirely full. So we'll take that amount and then we're gonna determine the difference between what he's actually earned in taxable income minus the full brackets already of 144,489 right here. So we'll do 29,877 plus the difference between these two amounts. The difference between those two amounts is taxed at 29%, which gives us a total of 34,375 for Mr. Amar. For our second taxpayer here, we have 95,000 bucks. This is similar to the previous example that we saw in that we're going to determine that this gentleman falls into the 26% tax bracket right here, meaning we can start out with this amount, 16,554 right here. And then we're going to determine the difference between this amount of taxable income and the high end of that second bracket. We'll multiply that difference out by 26%. Add them all up, and we've got 17,010. We do similar calculations for the next group, or the next taxpayer, who is Kenzie. Taxable income of 64 grand, putting Kenzie square into the second progressive rate bracket. Ta-da! So that means we'll add the full first bracket, 69,991, times the difference between taxable income and the high end of that first bracket. Add them all up. We've got 10 grand and change, and then we have our final example here, Deepika, who's really making some major bank at 390 grand of taxable income per year. So she's up in that highest bracket, meaning we're going to start with 47,669. Let me use a different color. Ooh, orange is a nice one. There we go. So 47,669, that's if the first four brackets are full. We see that right over here. And then we just have to say, well, everything else that she earns in terms of taxable income is going to be taxed at 33%. So 390 minus the amounts that have already been taxed times 33%. Add them up. We got 108 grand worth of tax, which is not terrible on $390,000 worth of taxable income. All right, there you go.
We've talked about gross individual federal taxes payable. Now we're going to talk about net individual federal taxes payable. That's the subject of our upcoming video. Just a real quick sneak preview. So we take an individual's non-refundable tax credits, we deduct them from gross federal taxes payable, and that gives us our net federal taxes payable. Gross federal taxes minus any non-refundable tax credits equals net federal taxes payable. And this is generally what people end up paying. So I advise you to click on the link below, follow through to the federal tax credits video, and we'll take it from there.